Hi everyone, and welcome to this Friday live event, which we are starting today. The series called "Investing with Factors." I'm very uh, happy to have and thrilled to have Rajan with me here. So, Rajan is an independent investor based in Singapore with over 2 decades of experience in investing and finance. And believe it or not, in the last 3 years, he's published about 19 papers and most of them on factor investing, and I've been fortunate enough to have been part of one of them, and I've had a chance to work with him, and he I think his indulgence has been awesome in terms of helping me learn and helping me grow as a factor investor. So many things that I didn't know as a practitioner, or we tend to overlook. But Rajan will pull you down and say that, boss, this is the way it has to be done, not that way. So, I'm really honored and thrilled to have him here. So, with that, I'll just pass it over to Rajan for his opening comments on the subject of factors in India. What's his big picture view? What does he think about it? And then we'll go over the what we're planning to cover today. The way we planned it is about 30 minutes uh, of the event. The first 20 minutes is where we'll present our findings and refer to some papers that we have. And then the next 10 minutes, we'll have a Q&A. So if you have any questions, please type them in the LinkedIn chat box, and we'll answer those questions after 20 minutes. So with that, Rajan, over to you.
Thank you very much, Anish. Really appreciate your generous words. Uh, the interest in factory investing is something that's been around for going back for a long time. Value investing is one of the foundations of factory investing has been there going back to the time of Ben Graham. But most recently, there's a book that got published by Antti Ilmanen, which is called Investing Amid Low Expected Returns, which really talks about the kind of change of regime that many academics as well as practitioners are expecting. And what that book does in a very masterful way is to show that how factors can be part of any long-term portfolio. Now, my work in India really was to kind of explore, because factor investing is an empirical science or empirical approach. The first thing you want to do is to make sure that does it work based upon the data that one has. And so a lot of my work initially was really to try and see if factors work in India, because whenever you talk to any practitioner, it was really about factors never worked in India for a variety of reasons. I was fortunate enough to be able to see that a number of the research papers that have been done outside in the West and in Europe, they're actually, the results are largely similar in India. You have got to adjust for the market's structure in India, specifically liquidity, our top-heavy kind of stock universe. But once you start to account for that, actually the results are very, very similar. The second thing that was very encouraging is the use of strategy indices or factor indices that have come up over the last few years in India. And both, whether you take the Nifty indices or the BSE indices, both of them have got a range of factor dash strategy indices that are available. So it looks like to me that having a factor-based portfolio in India is not necessarily something that one would say is something that India is not ready for. Clearly, between the book that Antti Ilmanen has written and the kind of work that some of the factor indices show, there is a space for factors within any portfolio in India. And with that, Anish, always a pleasure to work with you, and looking forward to this series where we talk a bit more about factors within the Indian context.
Thanks, Rajan, for your opening comments. So, this is what we plan to cover today. We are going to cover factor premiums, how we understand them in the academic sense. We're going to cover long-only factor premium, where we've taken the NSE indices as a proxy for long-only factor portfolios. Professor Rajan is going to correct me when I'm going to refer them to as as a proxy, and he will correct me saying that you have to distinguish between big and small, and so that's going to happen. Then we basically run you through the main crux of this discussion today is how factors behave over macroeconomic regimes and how regime shifts actually impact factors. So, and that is of interest today because we are in the midst of a very it's never certain. Macroeconomic or investing is never certain, but it is nonetheless a dynamic time, I would say, in the investing world, with inflation in the US and other parts of the world, supply chain constraints, and the war in Ukraine. So I think that is and perhaps the end of the long monetary experiment that the Fed has run with QE is perhaps coming to an end. So that it's going to bring about a number of structural shifts maybe, and let's see how we navigate those waters. Then we'll just sum up our talk for the day, and then we'll move on to Q&A. So just the disclaimer that this is not investment advice. This is just for educational purposes, and please consult an investment advisor before investing. So that's our standard disclaimer. With that, let me just kick off, just by explaining what this macroeconomic, what is the proxy that we've taken for the macroeconomic regime. And this refers to a paper or a white paper done in 2017 by S&P India, where they took the Organization of Economic and Cultural Development in India, and their indicator, which basically takes into account labor statistics, national accounts, purchasing power parity, productivity stats, and combines them into one index, and a rising CLI, which is the index, signals business expansion, and a falling CLI signals business contraction, which is the period that we are currently in. So, we're taking that as a proxy. So basically we're looking at business cycles and not market cycles. So even though on one graph you may see that we've plotted the factor returns on the backdrop of the Nifty 50, but the regions that we have shaded are actually as per the CLI and not market cycles. Those are business cycles. And then on the next slide, we've also mapped them against the CLI index itself. So, with that, I'll hand it over to you, Rajan. And
thank you, Anish.
This is your slide.
Thank you, Anish. So, I guess before we start, just a few comments about factors. There is a lot out there around factors, and I thought maybe we just kind of get us all onto the same page. So, in factors, risk is not a property of an asset in isolation, but rather it's how assets move in relationship with each other. Factors that underline assets actually determine the asset premiums. So for instance, we have a series of stock, all of them are, let's say, small caps. It is the fact that they are small that determines the premium that you would get on that particular portfolio. So it is small size that drives returns rather than the individual stocks themselves. It is the broad way to think about factors. Factors earn a premium for enduring bad times. If there were no bad times, there would be no premiums. So effectively think about you buy a factor and you expect to get paid for it, because when things go bad, the factor is going to will lose your money. And that's really important. All that factor theory does is to say that if you have different factors, they would have... Sorry?
Just to interrupt you for a second, I think we're getting some comments that your voice is echoing a bit. Is there
okay.
You can bring your...
Let me just try that. Is this better? Is
this
better?
Yeah, this is much better.
Okay. So the factor investing theory really is about saying that there are different types of factors, all of whom will have different sets of bad times. So the bad times for one factor A will not be the same as the bad times for factor B. And that really comes back to the crux of what we're trying to do today, which is to talk about which factors and what regimes and how do they work. So there are two different, there'll be some factors which have bad times in regime A, and other factors which will have bad times in regime B. Broadly, there are two kinds of factors or two sets of factors. One are fundamental economy-wide. These are things like growth, inflation, productivity, demographics. So these are all broad things that actually make a difference to the underlying economy, therefore to stocks. And the second set are usually tradable instruments. So this is the set that we're going to talk about, which is one, the market portfolio, the value, growth portfolios, momentum portfolios. So these are all what we would call as tradable factors. The theory behind factors can either be rational, which broadly goes around this asset earns some money because it is to compensate for the low return or negative return during bad times, or it can be behavioral. So some factor premiums result because of the way individuals or investors behave, which cannot be arbitraged. If it was possible to get arbitrage, then that factor premium would not exist. There's been a tremendous amount of work that has been done in the academic space as well as the practitioner space on factors. What Anish and I use are the Pharma French 5-factor model. The 5 factors are the market, which for those of you who've done Finance 101 will remember is called capital. Second is size. Third is value. The fourth one is operating profitability, or profitability for short, and then investment. So these are the 5 factors that Pharma French have done. In addition, we add 2 very well-known and well-accepted factors. One is called momentum, and the other one is called low volatility. These represent tradable factors, but they're all created through what are called factor mimicking portfolios. The problem in trying to identify what the return premiums of factors are, nobody can actually examine what a factor really does. So what we have to do is to try to create portfolios. These portfolios kind of mimic the underlying factor, so that these specific portfolios would be there to capture the effect of, let's say, the size portfolio, the value factor, or the momentum factor. And the concept of diversification is used because you really want to capture the effects of factors by averaging across many stocks with the same specific characteristics. So you define characteristics. So for instance, size, which is something is above this particular market cap will be large or big. Anything below this will be called small. Value, anything above this particular metric of value would be called cheap, or expensive, or this thing would be called cheap. So you predefine these values. And in academics, it's a fairly straightforward method. It's been used for many years. Practitioners tend to change this slightly, which is something that one should always be careful about, because then those factors will come up with a different set of returns. Now, factors are long-short portfolios, and this one is really important because they are neutral to the market. They're long-short on a very important criteria on size. So they are small companies and big companies that have these particular characteristics, and those are taken together to form the the factor portfolio, which is therefore then market neutral. This one is really important. Just for an example, if you were to take size is something called small minus big, SMB. We use the term SMB5 because Pharma French had a 3-factor model and a 5-factor model. So we tend to use a 5-factor model. So we call it SMB5. And that is the average return of 9 small stock portfolios minus 9 large stock portfolios or big stock portfolios. These portfolios are made out of the size of value, profitability, and investment. So therefore, we've kind of neutralized the entire market factor when we create the size factor. So therefore, when we add the 2 returns together, we're able to see them very clearly. The market factor is not affecting the size factor, and the size factor is not affecting the market. All the other factors are created largely between the characteristic that you want minus the characteristic that you don't want. So for instance, in the case of value, you would create the small value and the big value, and you subtract that out from the small growth or small expensive and large expensive. So all of these are effectively market neutral portfolios. We use the standard academic process, which is the 5 factors are formed every September. We use September because India has got a kind of a March cutoff. And so we take 6 months of information to come through, start creating the portfolio in September, and keep the portfolio all the way till next September. So it's held for 1 year. Except in the case of low volatility and momentum, where we create the portfolios every month. And they're held for a month, and at the end of the month, we create a new portfolio. Our portfolios are all value weighted, except for momentum, which is an equal weighted portfolio. But Anish and I have done this with also the value weighted momentum portfolio, and our conclusions really don't change. So that's broadly a quick look at what factors do. Now, looking at the chart that's there in front of you, frankly, what we try to do is using the CLI indicator, we've broken down regimes in India and taken the returns of these long short factors over these regimes. And what we try to highlight, the ones in blue really talk about the top 3 factors, and the ones in whites are the rest of the factors which are not doing that well. And in the summary, what we are trying to show you is how has expansion done. So what has been the average for our sample on expansion? What has been the average for the sample in contraction? And clearly what you're able to see is that there are some factors that are tending to do a bit better in an expansion regime, and some factors which tend to do better in a contraction regime. I want you to pay special attention to the contraction regime, where something called RMW, that is called robust minus weak. Robust is companies which have got robust profitability. Weak are those where companies which have got weak operating profitability. And what it's saying is that in contraction periods, you really want to have portfolios which have got strong operating profitability, in which case you will make, on a long short basis, you will make positive returns. Now remember, this is academic, this is without any cost, it does not really include any market specific thing, because you really can't short portfolios in India. There's a very restricted state that we have. So we'll talk about that a bit later on. But it goes back to what I began with, which is that different factors tend to have different bad times. Not all the factors have the same bad time. So Anish, if you could just move on to the next chart.
Yeah.
So here
you want to just, sorry for interrupting, but the average, if you see that, in an expansion period, the market beta really beats the pants out of everything else. Does that sort of, bring to the fore of how foresighted Jack Bogle was in some sense?
No, so again, that's a great point, Anish. The reality is that holding the market tends to do not bad for most investors, just holding the market. And that's what I think Jack Bogle's vision was. And the fact that he was able to do it in a very cheap, low cost manner meant that investors were able to take the benefit of the market all the way through. But the unfortunate part is that these things also have very strong drawdowns. So one of the things that we haven't shown here is what is the kind of drawdowns that people would have. And if you were to take drawdowns during the same periods, the market, for instance, the market factor would have a drawdown on expansion periods of about 9% on average in our sample. But on the contraction side, it could go up to a max drawdown of 32%, which means today's, we are kind of about 15%, right? So there's another 16% to go if you really are looking for what the average has been for the last few years or the period that we've considered. So in that sense, absolutely right. Market factor is a very, very important, and I think, unfortunately, not used by many investors in terms of building portfolios.
Yeah, another interesting point for me and a happy point for me is that momentum does well both in expansion as well as contraction. It does much better in contraction. I mean, in the long short version. but if you look at it, it's also in the top three, even in the expansion phase.
That's right. Ali, I wanted to talk about that in the next couple of slides,
Okay.
but I think this actually works very well. So the reason why momentum does the positive thing is, remember, it's a long short portfolio, which means that when you're short, if it's doing well, you'll actually make money. So if you were to look at 2020, where in the period October 18 to April 20, you'll see momentum is the top portfolio. It's a top portfolio primarily because the market went down very rapidly, and the short side of the portfolio did very, very well. Now, when you go and do the same thing with the long-only portfolios, then momentum does not necessarily do well all the time. Right? And that's really important. In the case of size, in the case of low volatility, in the case of quality, these portfolios tend to do well because even in bad times, such as recession, people tend to go and buy companies that have got low volatility, which means they don't have too much beta to the market. So they will naturally do better than the market. They tend to buy quality companies because they have more free cash flow, for instance. So those stories that people talk about when they are trying to argue an investment thesis, that now naturally gets built into these factors. So underlying each one of those theses is a factor. And so when you come back and look at it, market value and momentum, or in the up markets, you see size and quality tend to do good along with momentum. Size, small cap does better when markets are rising because they normally have a small low base, they are high beta. So you naturally expect small companies to do better. In the case of contraction, small companies will do significantly worse because again, they are high beta. Momentum does well because the market is on an upswing, and if you're rebalancing the portfolio every month, you tend to do better. But of course, when you translate that into a transaction or into a tradable portfolio, transaction costs become very critical. Quality companies always, whether the market is going down or the market is going up, you'll always find that quality companies are slightly more at a premium all the time. The one piece that in the factor piece, the factor expressions does not really show as growth, that is effectively seen as anti-value. And that's something that we've not really shown here. But if you were to do anti-value, that's the inverse of value, then growth in India in expansion times also does very well. Right? And if you were to go back into the previous slide, you can have a very quick look at that, because what you'll see is that value, which is seen as HML, in expansion times does kind of, you'll see that it is kind of negative, but that's because the portfolio that you have is built on cheap companies. But if you had a portfolio that was built on expensive companies, it actually flips around.
Got it.
Yeah. And now if I would to go on to the next slide, Anish, which is the CLI. So this one really talks about the business the business cycles. And again, you'll see broad brush, it is the same kind of thesis that comes up. What we've done here is that in the 2020 period, unfortunately, the indicator went sharply negative. It was down to the late 60s, mid 60s. And so we just cut that out. That's why you see a straight line. But the reality is that in India, business cycles have been fairly constrained in terms of their ups and downs because they trade in a very narrow band. If you were to use the same metric that S&P had used. So as we see in the long-short version, there are factors that make money in bad times as we see it, which is times of recession, times of contraction. That's what we see. Now, in the next part, we're going to move it away from a theoretical construct into a more practical construct. And the more practical construct in India is really to create long-only portfolios. So I would say that the broad results in terms of the factors that tend to work during expansion times and during contraction times, they tend to remain the same as long-short portfolios. However, the value changes. The value changes in the sense of the absolute return that you make, and we'll talk about that a bit later. In the theoretical construct, each of these portfolios have about 90 stocks. So there's actually a pretty large, well-diversified portfolio that gets created. And when we come to the factor indices are long-only portfolios with significantly smaller number of stocks in their holdings than factor mimicking portfolios. So that is something that I've explored with Harish Krishnan in a recent paper on factor exposures. But Anish, I'm going to pass this over to you to talk about the factor indices.
Yeah.
Because that then will tie up nicely with some of the conclusions that we made.
Yeah, thanks, Rajan, for that. So so what Rajan explained is the purest way or the way to look at factor premiums. And there are funds, not in India maybe, but in developed markets, which do run long short portfolios, factor portfolios. So they're not that theoretical. But in India, because of the depth of our market, the practicalities of shorting small caps, which is we don't have a very robust securities and lending borrowing mechanism, so we are not able to short mid caps, short mid and small caps. Anything which is not in FNO is effectively not you can't short that without a lot of friction. So again with when we look at long only, we see that during expansion phases, really, it's value, quality, and size. Again, what Rajan explained is that these tend to have India is a high beta market, and size and value are again two factors which have high beta, and if you look at the drawdowns, they can be pretty high, but they do deliver for you. If you are able to get those expansion and contraction periods right, if you are able to time it right. Quality is something that has worked in both expansion and contraction on a long only basis, and even momentum, I would say, has not done bad at all. It's done about 30% on average. And again, remember this: the last contraction is not over yet, right? We still just 9 months into this contraction. On average, a contraction lasts about a year and a half. So we may still have about 6 months to 8 months to go before we get out of this contraction. So the results for the last contraction period are still yet to be out, because we can only determine when a contraction period ends in hindsight. So the market factor also has delivered fairly well, but what has done well in terms of absolute numbers, I would say, is value, quality, and size, which the numbers show. But if you take the beating or the drawdown that you would take in a contraction, and if you were planning to hold this through both up cycles and down cycles, if you see that low volatility is delivered on average about 32% in the expansion period, with 3% in a negative 3% in a contraction period, while momentum is delivered again another 30% with an average of 3.5% in a negative 3.5% in a contraction period, whereas value has taken a bit of a beating in a contraction period, almost 5 times the beating that momentum and low vol takes, versus size, which has taken a beating of about 19% in a contraction period. So the risk reward is fairly there clearly for us to see. And again, remember, these are not all like to like, because we've taken implementable indexes on which, except for the value proxy that we've taken, there are index funds and or ETFs available on Nifty 50, Momentum 30, Quality 30, Small Cap 100, Low Vol 50. They're all indexes are available. We just don't have an index or an ETF on the Value 50. But we felt that was a better proxy than the Value 20, so we've taken that into account. And again, you can see that during we've taken the Nifty as a backdrop here, but the shaded portions are as per the business cycle expansion and contraction as per CLI. So you can see that that in the last four periods, it's been momentum which has featured both in contraction as well as expansion periods. And we've also seen quality which has performed extremely well in contraction as well as expansion periods. Um, and it's been in the last expansion period, which is post-COVID, that size and value have come into their own and have taken over and passed on the baton from quality and low wall to size and value. But momentum still, has at least maintained its spot in the top three. So, with that, let's move on to the next one where we've looked at, uh, because the first portion was a long short uh, portfolio and the second one was a long only portfolio. We wanted to see, is there any loss, or is there something um, that we lose when we do long only? Are the factors very different from what they appear in a long short portfolio in an expansion period and in a contraction period, or are there any or significant overlaps? So what we found is that, two out of three factors overlap in the three expansion periods that we saw, and we saw momentum and size had overlaps in two out of those four periods. And the market was a top performer in three out of four periods again, in the full factor portfolio. But even in the long only portfolio, market did appear in the first expansion period. It was there in the top three, but after that, it may have dropped down to the fourth place. But we've seen momentum appear quite regularly. We've seen quality appear quite regularly. So Rajan, any thoughts on this overlap on expansions before we move on to contraction?
Uh, so again, I think this thing does come back, Anish, to broadly what theory would tell us in terms of what you would expect higher beta kind of stuff would do well in expansion.
Right. So contractions are were actually a bit of a revelation for me. I thought I found something very interesting. In contractions, I found almost in the last two contractions exactly the same factors in the full factor and the long only version, and in the October 2007 to March 2009 contraction, two out of three factors were the same. So Rajan, how do we sort of reconcile this?
Yeah, so for me, Anish, honestly, the momentum piece coming up on the long only was a real struggle, because I would, not normally what you would find is there are momentum crashes, and when momentum crashes happen, which usually happen during periods of contraction, it takes time for momentum to come back. Academic momentum is usually defined as 12 months, skip a month. So that means you take the previous month's price on the numerator and 12 months ago price as the denominator. So what Harish and I did, and I don't know if you could just share table 9 from that paper, because what Harish and I did was really starting to look at how these portfolios were constructed. This one. And if you really start to look at it, we'll find that in momentum, what we did here was we actually took the return series of each of these indices, and from each of the indices, and then we kind of regress them against what the factor portfolios were. And then we tried to figure out what the exposure of the factors were on these momentum indices. And as you can see, in the second grid, momentum turns out at about 50-60% exposure for the momentum indices, but a large chunk comes out from quality.
Right.
So for us, that reflected something that we need to really think about in terms of the portfolio construction of these particular indices. Now, these indices are usually rebalanced either on a semi-annual basis or a quarterly basis. They have a much smaller number of instruments that they hold. They're basically 30 or 50 instruments is where they would be out at. The rebalancing every 6 months is also done not on a value weighted basis, but they have some tweaks in terms of the way that they decide on how to weight these the stocks. And therefore, the construct of these momentum indices are not necessarily what you would expect academic momentum factors to be. So for us, the only explanation I could come out with was that there was a reasonable amount of quality actually sitting as a factor within these momentum indices, primarily because of their construction, which then kind of started to explain why we had them appear within the short side, within the contraction side of the business cycle.
Got it. So should I move back to the presentation?
Yes, please.
So why we've kept the last grid blank is because, like I said, we are not completely done with this, and we can only take some cues from the past and sort of guess or make a calculated guess. What are the factors that could do well in this downturn? This downturn is not over yet, I think, and we are about 8 months into it. But summing up, I think Rajan spoke about this. Rajan, do you want to cover the first point about low overlap between long short and long only factors?
Yeah. As we saw in the very first chart, first table, where the momentum, the low wall, the two quality portfolios, we're calling them quality portfolios because there's some exposure to quality. These actually have positive returns even in contraction periods. But the long only factor portfolios, they do have negative returns. So it's kind of becomes a least worst amongst a set of bad cases. So if somebody was looking at a factor portfolio or a factor index and saying that, look, I'm always going to be positive, I think you may have to rethink your assumption. It is very clear that there is the downside. If you look at maximum drawdowns, you also see in contraction periods, long only portfolio tend to have a lot of drawdowns, and they can be quite significant. So people do need to be prepared in factor portfolios for significant risk.
Got it. The second point, which is there is a stronger overlap between quality and low wall both in the long short and the long only version during contraction periods. To us, it appeared that both these factors are so strong. The characteristics of these factors are so strong that they are surviving different implementations. The inherent qualities of these factors are, whether so even in a long only version, we are getting quality and low wall across contraction periods. So, one thing I wanted to show here was what are the industries that make up, and this is in reference to the paper that Rajan and I did. While it may appear a lot of color here, but I'll just try and sort of interpret that for you. So for low wall, you can see that it's the green ones are made, that those are consumer non-cyclicals, what we would call the FMCG companies, and the blue one is the healthcare, which is again a defensive. So you see those feature quite a bit in the low wall portfolio, and in the quality portfolio, it's the green one, which is consumer non-cyclicals, and financials that surprisingly feature quite strongly, at least towards the end of the period. So we just wanted to give you an insight into what factors are these what industries are these factors exposed to, rather, in when we look at. But as you can see, it's not one industry that's dominating. There are made up of a number of industries. So, but it's picking up quality, and it's picking up quality again, like Rajan said, defined both as profitability or investment in the long short version. It could be both, and but in the long only version, I know that the indexes pick up ROE and ROC and operating profitability to construct those indices. So that was an interesting fact that we just wanted to bring out. The last point is, again, which Rajan always never fails to remind me, is that not all long only portfolios are not the same, and he and Harish have done a paper on that. Uh, the prime the prime parameters that change here are weightage and rebalance period. So that's covered in the paper that Rajan and I did, where momentum clearly, the signal starts to decay after 3 or 4 months. That's the max. Perhaps you should be waiting to rebalance the momentum portfolio. Beyond that, it starts decaying. But value is rebalanced once a year. So those are sort of low frequency signals, but the momentum long only momentum index which we have in India is rebalanced once in 6 months, and the other one I think is rebalanced once a quarter. The second point is the weightages. Uh, one factor index again in momentum uh, is not pure value weight, nor is it pure factor weighted, but it is a factor tilted portfolio where the market cap is multiplied by the factor rank, and that is taken into account to formulate the portfolio. Whereas in the other index, it is a pure factor rank. So that weightage impacts returns and more importantly implementation friction and cost quite a bit, as we've seen in the recent case where an ETF has been in the news and has a significant tracking error because that some companies which are which have a very high weightage in that index are but have very low liquidity. So it's fairly hard for them to replicate that underlying portfolio with low friction and low transaction costs, rather, which add up to a low tracking error. So with that, I think the question that we were trying to, or what we were trying to get you guys to think today was, what's likely to perform during this contraction period? I think the answer is fairly, obvious by now. It looks that, from going by previous trends, it's quality, low volatility, which tend to stand out, and they make sense intuitively also, right? From a industry point of view, and also from a factor characteristics point of view, because they tend to be defensive. They tend to have defensive characteristics. They have companies which have strong operating profitability and strong ROEs and lower volatility. And as we know, in down periods, volatility usually accelerates. So that sort of explains the economic intuition behind that. Uh, we've unfortunately run 15 minutes beyond the time that we had budgeted. If there are any questions, let me just quickly check the chat if Vishaka has. So yeah, so Rajan, one question from the audience is that how do we decide the constituents of these factors, and are there any benchmarks available, or can we create our own benchmark?
Excellent question. I guess the academic construct is actually pretty straightforward, which is you take the universe of stocks that you have. Uh, uh, in something that I have done, which is try and replicate this for the Indian market, equity market. I use it's a universe of about 4,000 odd companies at any point in time on any given year. It's about 2,500 live companies that are out there. And then I use the standard process of, for value, for instance, it is book to market, and you take the top 30th percentile and the bottom 30th percentile. Because of book to market, it's the inverse of value in that sense. And then you can create that portfolio every September or whichever month you want, and that should be fairly straightforward. If you do not have access to either the data sets or you do not have access to the computational processes, the good news is with all these factor indices now you actually have a universe that you can think about. So you could go into the NSE or the BSE websites and actually look at what are the constituents that those factors have, even though that they're not strictly factors in that sense, but at least it gives you a flavor. In terms of benchmarks, this is a tough one because there is the long only version and there is the long short version. The long only version, I would say, today we do have these factor indices that are out there for the long only version, but for the long short, at the bottom of this, at the end of this presentation, you actually see there's a link where you can have access to the return series for factors, long short, and within that there are the individual portfolios which you can pick up and then run the return series for those. And those are available. You can download them and use
them. Got it. So I don't think we have time today for the questions, Rajan, but I'll just ask you one question in terms of how do you choose? Do you go for a single factor or do you have multiple factors in your portfolio? How do you think about that big question?
That's an excellent question also. As I struggle with that question, for me, I come back to what factors do. Factors are there with different bad times amongst them. So I like a well-diversified portfolio. And so what I tend to do is I tend to create my factor portfolios because I have access to the data sets and all that. And so I tend to use a process where I take all the stock and move them across these factors to choose my final universe of factor-related assets that I would put into my portfolio. But if people don't have access to all that, the data sets as well as the computational or even the time to do this, frankly, I think the easier option is you just create single silos of each of the factors. Factor indices are a reasonable process to start. And once you start with that, all that you've got to then create is to say, how much exposure to momentum do you want? How much exposure to value do you want? How much exposure to size do you want? I think that becomes a simpler process, administratively a lot less overhead, and something that you can keep track of pretty much every quarter or every year. So I think for the person without access to the data sets or the time, doing single factors is a far easier thing. If you have access to the data sets and the time and the computational ability, then really creating your own factor data set is possibly the best way to go because that's unique to you.
Correct. I think we'll take just one more question where somebody is asking, Nagraj is asking that, since we've looked, large amount of our period is post 2008. So is the quality factor dominating because P ratios have gone from 15 to 75x and a lot of money may have flown towards quality stocks? And that is the reason that, that people are, the quality factor has performed extremely well.
So, Nagraj, actually, the fact that quality performs in bad times is not just within the Indian data set. You'll see this across. You go to the US and go back test across there. Go to Europe and do this. Quality and low vol tend to do good irrespective of the market dynamics. So whether it is India or any other geography, whether it is asset type A or asset type B. So I don't necessarily think that this is unique to India and that this could be a misleading outcome. Having said that, I would say two caveats. The first caveat is quality companies as we define them are either profitable companies, strong, robust operating profitability, or conservatively managed in terms of their investment group. People could have different quality metrics. And if you're going to use a different quality metric, all that I would urge you to do is just do the same analysis because it's actually quite simple once you've decided on your quality metric to run it. But using just these two really basic approaches, the quality metric, the quality measure does stand. So that's caveat one, depending on which quality measure you use. And caveat two is, please remember that these are all statistics. And so they are based upon a set of environmental conditions. If the environmental conditions change, you would have potentially some other new variables that you have to factor in. Factors are tend to be looked at over long periods of time. They're not there for short periods. They're not there for kind of trading factors. There's a whole exercise around trading factors, but that's a different conversation. For the average investor, factors should be treated as something over the long term. So therefore, I do not necessarily think it's a misleading outcome, but there are a couple of caveats that I would put on.
The next question, Rajan, and I promise I have not planted this question. It says from Prem Kumar. It says, "Hi, thanks for the wonderful presentation. I wonder why there is no fund house offering factor rotation strategies, as it could be tax efficient as well as tracking error being manageable with limited asset size." This is a question I've asked you
Yes.
numerous times in different ways.
Yes.
And probably it's an idea you could give to Harish at some point in time, that but what do you think about factor rotation?
So I'm not a fund manager, so I want to be very clear about all that. So again, just on the academic side, the factor rotation strategies, there is an ongoing debate as to whether factor rotation actually does work. There are studies that show that it does work in certain circumstances. There are studies that show it the other way. So I would say, purely from an academic point of view, the jury is not yet at a consensus level. So the jury is still out on this. There are, if one really looks at this, the trouble with thinking about factor rotation is, what is the external variable that you're going to be using that is going to determine that you're going to rotate in or out?
Yeah.
As you think about trend following, is that going to affect the correlation or the covariance of asset returns for factor portfolios? So there's a bunch of issues that one has to just technically go through, which is why I feel that factor rotation is still a fairly challenging exercise. But having different sleeves of factors and then diversifying across those sleeves could be a completely separate story. There are enough funds out in the West that do it. And even in India, you'll see some of the factor indices, which are multi-factor indices that are available. So I think that one is the easier problem to solve. Factor rotation is a slightly more difficult problem at this point.
Yeah, I think AQR has done quite a lot of work around these areas. They've taken valuation metrics, they've taken momentum as a, is it as momentum at a factor level. And you're right, there is no clear answer here. As in finance, we know there is no free lunch.
Yes.
If we want factor rotation, we would be taking either some risk that we don't know, or there would be some upside that or downside, and some extra downside or some upside that we are letting go of. So for the rotation efficiency that we want to be in the best performing sector at that best performing factor at that point in time.
Yeah.
So yeah, I think with that, I think we've come to the end of it's almost an hour. we had said we'd keep it 1 hour, but thanks a lot. This is the bibliography. We'll probably put up the presentation with a link on LinkedIn and our website, and you can download the presentation from there. We are also going to be it's also being recorded, so we are going to upload this on our website, on our YouTube channel. Sorry, and if you want data on full factor long short, the way Pharma French do it for the world, and till 21 professors Sobesh and Agarwal and Verma were doing it for India. Again, this is something that I've been irritating Rajan about, that please put up the factor research, the factor data sets, and he's been kind enough. And it's the second month now, so these are available on this link, Invespar /research. So with that, we've come to the end. Again, the disclaimer that this is not investment advice, purely for educational purposes, and please consult your investment advisor before investing. So thank you everyone for being a part of this discussion today. We had some excellent questions, some very good participation. These are our Twitter handles and our website. So, feel free, shoot us some questions whenever you want. And with that, thanks, Rajan. We look forward to having you again on some future episodes of Investing with Factors. But this has been a great kickoff to the factor journey, for us in India. So we hope to
Thank
keep
you for
sharing
having
it.
me. Thank you for having me, Anish, and thank you for being so patient.
Thanks. No, it's always something to learn from you. Thanks.
Thanks, everyone.